Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me this afternoon, we have Erin Fennimore, Vice President of Taxbit, Tal Zackon, co-founder and CEO of TRIS, and Jessalyn Dean, VP of Tax Information Reporting at Ledgible. We're here to discuss digital asset tax reporting regulations and the compliance timeline. It is great to have everyone with us. Welcome to Trade Talks. And Erin, I want to kick this off with you. If you could give us a brief overview of where you sit within the crypto and tax ecosystem.
For sure. Thanks, Jill. Hi, everyone. I'm Erin Fennimore, and over at Taxbit, we've really developed a platform which tackles all of these crypto regulations, both in the United States, and I think we're going to touch on the global landscape, but overall, just a massive kind of explosion and clarity for information reporting rules that enterprises are going to focus and have to face. So that is really what we have developed and are excited to talk about it today.
All right. And Tal, tell us about your role within the ecosystem as well.
Sure. So we've recently launched our TRIS Analyst. So when we work with companies, we help them manage all their accounting, audit, and reporting for digital assets. TRIS Analyst is actually AI that knows how to sit on the data, and any kind of regulation or reporting rules that come in are analyzed and already done for you by using different artificial intelligence models.
Right. And Jessalyn, I'll ask the same of you with work at Ledgible.
Yeah, so if we look at the traditional financial institution space, they had 20 plus years to implement and secure down 1099 reporting for traditional financial assets. And here we have crypto brokers that are going to need to start complying with 1099 reporting in a really compressed time frame, in comparison. And so Ledgible sits in this space serving clients that need to do cost basis reporting with regards to 1099s, because blockchain and digital assets are very unique when compared to traditional financial products.
And Erin, let's start at the top here for a moment and talk about some of the significance of what the Treasury Department has put out in terms of guidance and tax reporting regulations. Any similarities or differences in terms of how other assets are reported?
Yeah, so as Jessalyn just noted, in the TradFi space, these regulations have existed for a number of years, right? Both for cost basis rules, documenting account holders, and actually reporting on, primarily the 1099-B if you're in the broker context. But what these regulations do is they really bring the digital asset ecosystem into scope, right? So they're a step in the right direction, providing that much needed clarity. So as an enterprise, particularly, I think we're more focusing on the kind of centralized exchanges with a lot of this conversation. It gives them that clarity to understand as a business, what are my compliance obligations within information reporting? Although, as soon as clarity comes, questions come along with it. So there's a lot that we are still waiting for.
Yeah, and Tal, what's so interesting is that the digital asset space, there's no regulatory framework. It hasn't even been identified in terms of what it is as an asset yet. Do you think by the Treasury providing some sort of framework that helps to advance the overarching framework around it? Oh, you're on mute.
Sorry. There are some kind of frameworks that we are already familiar with. If you're just looking at cost basis, for example, FIFO weighted average, spec ID, these are common frameworks that also are used in digital assets. What we've been able to see is once you launch AI at these kind of frameworks, it's very easy for the machine to start learning exactly how to take care of different assets. Could be on centralized exchanges, could be on-chain. And if you're able to parse the smart contracts and really understand the context of the transaction and what is the asset behind the scenes, then things become clearer.
Yeah, which is so interesting, Jessalyn, because we think about the space in general, it really does come back to user experience and what institutional participants are familiar with. So this does take some of the complexity out of it, or at least remove some uncertainty.
Yeah, when we first saw the draft regulations that came out, followed by the IRS draft Form 1099-DA, it looked kind of like a 1099-B, but there was a lot more information on there that was very confusing to taxpayers, retail taxpayers, or institutional taxpayers. And when we saw the later versions of the draft Form 1099-DA, it looks and feels a lot more like a 1099-B. And we see that this will create a lot more comfort from the average taxpayer that maybe has been scared off from holding digital assets for tax reasons, for not because of the way that they're taxed, but because of the complexity of tracking your own cost basis, tracking all of your assets that you're selling. And so when you have 1099s that come out with these assets, they look and feel a lot more comfortable to both retail and institutional investors.
Right. Erin, are there any notable changes in the more recent version of these regulations?
Yeah, I know we have a condensed timeline for this interview, but there was a lot that changed, right? I think the most important things to highlight of what changed is the timeline. That was a big difference between the draft and the final regulations, and it really gave that phased implementation starting in 2025 instead of all the way back to 2023. And then the second big thing to note is that it really narrowed the definition of who was falling into scope in terms of what they consider custodial, custodial entities. Primarily think of that like centralized exchange, your PDAPs, which are processors of digital asset payments, crypto ATMs, and then real estate. So it left a lot still to be determined that we're going to wait for additional clarification. It offered clarity in terms of the phased in approaches from 2025, 2026, and 2027. And then a lot of clarity in other areas. Fee treatment, for example, aggregate reporting. So really giving nuanced detail of how you report specifically for stablecoin. Backup withholding was a big topic. So there was quite a number of areas where they differed, but I would say the timeline and the scope is really where a lot of the focus has been.
Mm-hmm. And Tal, when you think about regulations, how are they fueling, or how are they the catalyst for creating tools and management resources for reporting digital assets? Tell us about some of the innovation that you're seeing as a result of digital assets, AI, and the regulatory framework being put in motion.
Sure. So up until now, I think most CFOs and finance teams, when we look at organizations and interact with digital assets, we're kind of on top of things, but they were always having one eye set to the future to see what might happen and what would happen with the regulation. I think that now not only these clarifications, but also if you look at the new administration that is coming into place in the States, everyone is kind of already thinking about what might happen in a good way. And that also means that we are seeing more and more companies moving from like zero digital assets on their balance sheet to start looking at stable coins, starting to look at how they can interact with the staking, for example, and how they can engage with real world assets. And once they do that, they understand they also need the infrastructure in order to manage all these transactions and assets on their balance sheet. So we're seeing an uptick in companies reaching out to us and understand how we can support them with these kind of activities. And when you think about the team that they'll need to build in order to support this, many of the finance team members aren't that familiar with digital assets. So we are seeing kind of a demand to have machines or AI taking over that part of the reporting, accounting, tax, and any kind of back office needs for these companies.
Yeah, and Jessalyn, I'll ask you the question somewhat a different way, because you would notice that certainly you don't want people not reporting transactions, but you also don't want duplicate reporting or adding more confusion into the system. So how are you advising clients in terms of the timeline, and then of course, what they need to do and what they don't need to do, and how to execute on that?
So there's this phase that we're in with these regulations where, some of the major players in the market understand that they are brokers and they need to issue 1099s, and they're actively out there preparing for that. And then we have a whole lot of potential brokers out there that either haven't accepted yet that they're in scope of these rules, and so they're sort of in denial phase, or they don't have the expertise to realize that they are in scope. And so some of the conversations that we've been having with these brokers, we're hearing these conversations where they say, yeah, okay, if you have a read of the rules, it sounds like we're in scope, but there's all these other parties that touch the crypto. So we think they're probably the broker instead. It's not us. And we have to sort of bring clarity to them that actually the definitions might mean they're all brokers. And what the rules then do is kick in with this multiple broker concept that says we ideally don't get duplicate reporting. So if there's more than one broker in the structure, there is a set of rules that determines which one should ultimately do the reporting. But we see that this is probably going to lead to a lot of breakdowns where potentially nobody's reporting because they're not communicating with each other when they do these analyses. That's more likely than the duplicate reporting, but we will very likely see duplicate reporting. And this is not uncommon. This is actually something that happens a lot in the payment processing world with 1099Ks.
Yeah, and Jessalyn, that's a great point that you bring up, and certainly something that needs to be acknowledged, because when you talk about scope of practice, whether it's in digital asset space or any industry across the board, there really it's so nuanced. There really is no way of getting around that. As long as the regulators interpret it as such a way, I mean, scope of practice, just there is not much wiggle room there. So I'm sure that's something that the industry is going to have. It's going to be a quick lesson to learn, I guess is the right way to phrase it. Erin, when you think about alignment with other global regulatory environments, what does that look like? Are you seeing some alignment there, or is it still very fragmented?
No, it's definitely information reporting is a global conversation. We already see that within traditional finance with other existing regimes. What we're seeing now is that we're seeing that expansions for digital asset players and digital asset focused regulations. So I'm sure you've heard of things called, DAC 8 and CARF. Those are the expansion of information reporting rules to Europe and frankly the rest of the world. And something we've seen similarly in TradFi with something called the Common Reporting Standard, or CRS. So overall, it is definitely not just a US focused regime anymore in terms of collecting customer information, collecting the transactions, and the various type of payments, and reporting that both to governments and also recipients. We're going to see that expand, in the next few years for a global perspective. So it really, taking a step back as an enterprise, if I'm a global digital asset enterprise, really looking at that landscape to prepare accordingly.
Erin, is there anything that retail investors need to do or prepare for, as we're just a few months away from April 15th, which of course is, D-Day for taxes in the US?
Yeah, I think from the, taxpayer perspective, it's really to understand your obligations. We still have some areas of that don't have total clarity, and there's disparity. That's the whole purpose behind information reporting regimes, right? It's that connective tissue between taxpayers and enterprises that are actually making and have the information with respect to the income paid or capital gains and the like. And so I would say, because we're not officially in the information reporting timelines, which do officially kick off in 2025 here in the United States, make sure that as a taxpayer, you have that information so that you're able to report accordingly.
Yeah, and Tal, when it comes to considerations that institutions and businesses will have to take into consideration before adopting themselves, or before mainstream adoption is more broad, what are some of those considerations that they need to take into account when they think about their strategy?
So the first thing that we see is that companies try to understand how they can build the infrastructure to execute on any kind of a strategy, but then also make sure that they aren't exposed to any kind of breach of regulation or any kind of laws, right? So they don't get fined. And we have seen companies that are getting fined left and right, especially in the US. If you think about a couple of years ago, Kraken with the staking activities, and Coinbase were able to fight it off. What we are seeing is that no one wants to be exposed to any kind of issues with the government, and they are looking for solutions from day one to make sure that they are aligned with what is needed. And we are seeing that many companies kind of left the US because they were worried about the regulation and went offshore. And I think that now, looking at the new administration and some of the clarification that is coming out in terms of taxes, we might see lots of business going back to the States, and a new bull run when it comes to companies being built in the crypto space in the States.
Yeah. And Jessalyn, when you think about best practices in terms of setting up your strategy, are there people, whether it's partnering with internal legal and compliance senior leadership, or are there external partners that you should be thinking about as well to advise you on what this landscape could look like? How would you strategize that?
Certainly, external advisors are necessary to understand and interpret the rules and determine what we call legal entity analysis and a product analysis, because there's usually lots of entities within a structure, and each of those entities hosts lots of different products. And so you need external advice typically in order to assess which of these products and entities are in scope of being a broker and which ones are out, and documenting that so that it can be monitored, because your business and your products regularly change. But more importantly, you have to start with your internal stakeholders. Many people think of tax information reporting as a regulatory requirement. Compliance, tax, and legal are involved. But there needs to be a stakeholder meeting and presentations and working group that contains nearly every aspect of the business. Customer service usually gets to be an afterthought, but it should be number one. How are brokers actually communicating with their customers at the beginning, middle, and end of the whole life cycle? Web development, engineers, data security. It is almost every part of the business. So building the internal stakeholder model is first priority. Getting these people on board, understanding where the budget lands, who's paying for this, and what value does it add to the business aside from the regulatory requirements. So that combined with the external advisors is the place to start.
Yeah, Jessalyn, I think that's excellent advice. And Erin, we'll wrap this up with you in terms of how you would strategize it, because it's not only just implementing the strategy, it's almost, when you think about it from a cyber perspective as well, we always hear about, having these fire drills and making sure that the, policies are it's dynamic. The environment's always changing, and so must enterprises to keep up with that internally and externally. So what's your advice when you think about setting up a strategy that's sustainable and also has the ability to be dynamic?
Yeah, it's a great question. And just to echo again something Jessalyn said, it's all about the stakeholder alignment. And then I would also layer on, in addition to stakeholder and process, it's getting product into that process, right? This cannot be a manual process. It's not feasible, both in terms of the volume, the timing, and the fact that, just like you brought up, it's dynamic. We haven't seen the finality of what's going to be required from an enterprise perspective. So you need to make sure that you have flexibility within the product and the process overall, so that ultimately you can be in compliance with the rules today and with what the rules are going to look like tomorrow and probably the next 10 plus years.
All right. Appreciate everyone's insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.